Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, I return to have another conversation with a long-standing friend and colleague of mine, Charlie Morris, the founder and CEO of ByteTree Asset Management and formerly a senior figure in HSBC Asset Management. Takes a global panoptic view of the world before drilling down to the kind of stocks that he likes and recommends to his clients for his newsletters. So, Charlie, I'm going to start with gold and Bitcoin because, after all, we are living in the age of Trump. And Trump is, by his own account, trying to not only make money for himself, but also do something for digital currencies. Tell us what's been going on there. What are the significant steps that have happened in the world of digital currencies since we last spoke, which was certainly about a year ago?
Well, I think the insinuation there is what's happened with Bitcoin before we get to gold. So we'll kick off with that one. Bitcoin's big step forward was last year, 2024, January, when the ETFs opened up in America. It was a very, very big deal. And people will tell you that Bitcoin's volatile, but I can tell you that the volatility has been continuously falling. And so Bitcoin has got more and more liquidity and less volatility, and it's become a sort of somewhat mainstream financial asset. What's fascinating to me about Bitcoin is it came from the bottom up. It was a grassroots asset. It did an IPO at a market cap of 150 grand. I mean, that just doesn't happen. So that's why the returns have been so high for the early adopters. So that's a pretty interesting thing. And so there's been resistance because it came from grassroots. It didn't come from the top. And so far, Bitcoin is very much owned by the people. There is a sort of movement for institutions to buy Bitcoin, or companies to buy, should I say. But that's really a regulatory arbitrage, in my opinion, nothing more. The Bitcoin maxis will tell you it's something else, but really it's just the fact that it's been hard to buy Bitcoin over the years, whether it's through bank transfer restrictions or financial products over the stock market. So that's all opening up. And then we've got, on the 8th of October, the FCA reversing the ban that was instigated in October 2020, enforced in January 2021. There was 10K Bitcoin when they did that. And now it's 113K. So it's a huge move that's happened during the course of the ban. So from the 8th of October, not only British retail investors, but more importantly, I think, it's going to be the global fund universe. And I'll be interested to hear your views on that, Jonathan, because if you're a fund, a UCITS fund or what have you, based in Singapore or Europe or somewhere, then if you had a touch point with London, the ban was in force. And so really what this means is that anyone can buy Bitcoin. I mean, maybe there will be restrictions in China and India and places like that, but basically the global investor can now buy Bitcoin through an ETF. And that's a big deal. You remember what happened to gold in 2003 when the Australian ETF launched, then London, then New York, and then gold became a thing in portfolios. So will the same thing happen to Bitcoin? Jonathan, will your investment trust buy Bitcoin?
Probably not, I suspect. Probably not until it's far too late anyway, let's put it that way. I mean, the question always comes back to, well, why would I want to own Bitcoin other than people say, well, it's going to go up? Well, that is always a reason to buy something, I guess. But it's not something that sits easily for those of us of advanced years and many years of experience in markets. We like things to go up, but we don't like buying things that we don't understand why they're going up or indeed what the point of them is. So I guess that's how I would respond to that. But I'm very flexible, always willing to try something new. But perhaps more relevant question is how I missed the boat. What's going to keep driving Bitcoin ever higher? Is that going to be simply demand from momentum following people or people who genuinely believe in Bitcoin as a social construct? And if you like, a badge to wear with honor?
Yeah, they're good questions. I fully understand your skepticism around it. It took me some time to get on board with it. And I fully understand why some people think it's a Ponzi scheme. But there again, some people think gold's a Ponzi scheme. The difference between them is their physicality. Other than that, they really are so similar in so many ways, whether it's in terms of the supply side of the assets, the huge liquidity. Gold trades $150 billion a day, according to the World Gold Council, which is nearly as much as the S&P 500. And then Bitcoin, we sort of pencil it in as $40 billion a day, but we don't really know. It's very hard to measure because it's so much going on in so many places. But two huge liquid alternative assets. That's the point. And I see gold as the reserve asset for the real world. and Bitcoin as the reserve asset for the internet, whatever that means. But if we look at the internet, it's been pretty successful over the last 3 decades, and it's best not to bet against it. So the internet's having a go at assets, and you might not like the shape of them, but this is it.
Well, let me turn this around then and say, well, you own Bitcoin, but are you holding it and trading it? What are you doing with it in your own portfolios?
Well, that's a very nice invitation, Jonathan, to tell me about my Bitcoin and gold product, Bold. That's how I own Bitcoin, and that's how I own gold. I launched it in Switzerland 3.5 years ago. It risk weights Bitcoin and gold. So, roughly speaking, at the moment, you're getting 70% gold, 30% Bitcoin based on the inverse of 360 days of volatility. It's rebalanced every month, and it's coming to London stock market in Q4. So, we're pretty excited about that. The whole point of Bold was to be the sort of gentleman's way to own Bitcoin. So if you like the idea of gold, but you want to spice it up a bit, then you can have a risk weight. So you've got the same amount of risk in gold and the same amount of risk in Bitcoin according to volatility. And so if Bitcoin goes down a lot, then you don't go down nearly as much. And similarly, if gold goes down a lot, you don't go down nearly as much. So they protect each other, but they have a natural low to negative correlation much of the time, low all the time, negative sometimes. And basically, you expect gold to do very well when things are going wrong in financial markets, and you expect Bitcoin to do well when things are going right in financial markets. So they've got a natural risk off, risk on blend to them.
Yes, I was going to ask you about that. Well, why would the correlation be low? But that's the reason. I mean, what's the underlying factors there that make them relatively uncorrelated?
Well, historically, gold always moved around with real interest rates and still does. I know the TIPS model has broken in the last few years as central banks have accelerated their holdings. But basically, the day to day fluctuations of the gold price are very sensitive to things like the dollar and to 20-year real interest rates. That hasn't changed. And so that's basically a risk off side of the equation. And, Bitcoin's a tech stock. It correlates with the NASDAQ. So there you have it. The other important thing I just mentioned about them, which I think is the next 10 years, is that the central banks own a lot of gold, always have done, and now increasing. The general public own a lot of gold, not just in jewelry form, but also as an investment. Institutions probably own less gold than they have done in the past. And pre ETF, they didn't own very much at all. But they owned a lot more in 2011 than they do today. So I'd say institutions are probably underweight, particularly private wealth. But on the Bitcoin side of the equation, the central banks own practically none, apart from some through confiscation or countries like El Salvador. But this is not mainstream. Institutions own practically zero. And so it's all owned by the general public. So I think it's quite interesting if we see a rebalancing there over the next 10 years. Bitcoin has been with us for 16 years now, and it hasn't gone away. It just comes out every cycle stronger, bigger. And there'll come a point where everyone will say 2% Bitcoin in their portfolio, what's the big deal? 5 or 6% gold, 2% Bitcoin, let's go.
So I think I'm right in saying that the amount of gold held by ETFs by the general public has been falling, right? Is that right about that? Or is that just the wealth managers and others like that reducing their holdings?
No, the gold holdings by value have been increasing steadily, and they are at an all-time high. The number of ounces is not at an all-time high. So the difference, of course, is a strong gold price in the last couple of years. But the gold ETFs in totality are something like $330 billion, and the Bitcoins are about $170 billion. We publish that data on our site, boldetf.com. And so it's $500 billion in Bitcoin and gold ETFs. Now, some of those people like gold, some of those people like Bitcoin, and a small minority like me own both.
Indeed. So that's putting the two together. But just quickly on the gold, then, as you say, there is a relationship with interest rates, other real interest rates, but it does seem to be not working quite exactly the same way it used to do. In other words, real interest rates have been going up and are pretty high by historic standards, but gold continues to march ahead. Is that mainly because we've got Ukraine, we've got the Middle East? Is it geopolitical factors there, or is it just central banks trying to protect themselves against what's happening in the US?
All of the above, Jonathan, but I think there's the other point, and that is that tips are probably mispriced. I always said it's the 20-year yield because the volatility matched with gold. We're in the sort of 15%, 18% zone. The 30 years too volatile, the 10 years not volatile enough. So I always looked at the 20-year, and let's assume that the 20-year treasury is a free market. Yeah, I mean, it might not be,
Okay.
but you're laughing. Okay, so that's an assumption I'm not sure all the reviewers will share. But the 20-year TIDs give us the implied inflation over the next 20 years. And that is a thing that has correlated with gold. So its TIBs have broken down. So for some reason, there's a low demand for them. And also, I think there's been this other argument in recent years, which is the confusion between consumer price inflation and money supply growth. And so people mean different things when they talk about inflation. And some would say, well, the money supply, which keeps on growing at 7% per year over the last 20 years as a trend, then that's your inflation benchmark rather than the 2 or 3% that we see on consumer goods. I mean, it's hard to know which is which, but I suppose once upon a time, they were probably much closer together, those numbers. And today the divergence is wide, and it is widely believed that the increase in the money supply is the driver of bubbles, because the money supply more or less matches nominal GDP growth. And all three of them seem to correlate with the valuation of, or the value of financial assets. So there is a link there. And I think it's legitimate to say the money supply CPI gap is one factor, and the other could just be simply investors, for whatever reason, have been dumping tips in recent years and underestimating long-term inflation.
Yes, indeed. I would certainly share that last point. Before we leave the subject of gold itself, I wonder if I could ask you, what do you think about gold miners and silver as an alternative to gold? Gold does appear to have been outperforming both of those categories. Is it time to look into the miners and silver as an alternative?
A very, very timely question. So I think am I right in saying that over the last 10 years, without having looked at the chart in the last couple of days, gold and gold miners, as in the GDX ETF or similar, have more or less done the same thing. And we've just started to see the miners start to show outperformance for the first time in a very long time. And the interesting thing about the gold price is it's gotten above $3,300. And okay, fine, it hasn't got to 4,000, 5,000, which the bulls were hoping for. But it doesn't matter. 33 is a hell of a big number for a miner. It's a hell of a margin. And I just think the gold mining stocks have been pretty conservative. And so investors haven't really assumed that they're going to make as much money as they have. And the reason for that is they probably assume that the gold price will come crashing down to 2,500 again. And it hasn't. So just gold staying at 3,300 is a boon for the gold mining industry. And I think that that's just beginning to be acknowledged by the sector. Valuations are now probably closer to fair on a historical basis. We're starting to see the more speculative miners, the explorers, outperforming the market. And that's always a good sign of the beginning of the end of the cycle. But yeah, I mean, we've owned the miners for quite a long time. It's been a good rise. But finally, we're starting to see that outperformance. I'm sure there's more to go because I don't think gold's going to crash anytime soon. Indeed, real interest rates, getting back to that, which are apparently irrelevant these days, or are they, are falling, or at least not rising. But they are pretty attractive numbers. And so, if the probability is that real rates come down from here, then gold might have another leg up. But also, the central banks keep on buying it at an alarming pace. And as I say, investors are underweight. So, what's not to like? I think the risks of gold crashing are quite low, and the potential for further upside is quite high.
So let's talk then about how this relates to what's going on in equity and bond markets generally. Do you have any particularly strong views about the direction of some of the key markets? In other words, US versus rest of the world. Is there some kind of change in that relationship? Perhaps some would say at last, others would say quite right too. Do you see US exceptionalism? Are you one of those who think that will continue? Or do you think that now's the time to be moving further towards other parts of the world?
I'm definitely in the US normality camp as it reverts back to its mean. I remember the 2000 to 2008 period where the dollar fell by best part of a third and emerging market currencies were strong and emerging markets were fantastic. Europe was pretty damn good as well. And those were great times. We called that the era of global growth. And then we had the financial crisis. And after the financial crisis, we had the profitability of the dot coms and tech. These companies had all made losses. The same was true with the biotech stocks in about 2010, 11. They had a big boom. And just one by one, US companies have just demonstrated this ability to deliver these really high returns and buy back stocks and so forth. And it's all been a bit too good to be true, whilst the rest of the world sort of looked over the pond and gone, how the hell do you manage that? I think there's a lot of dressing up of financial reporting in America. And I screen global stocks, not every day, but certainly every week in my research business. And I could never find anything American that stacks up on value grounds. Oh, that's a good price for that amount of growth, that sort of thing. Whereas the rest of the world is not difficult. I mean, you come across things all the time which offer compelling value. And that's what I do. I'd gladly recommend many more US stocks if that wasn't the case. And I think that, we've now got this narrow leadership. Is it top 10 stocks, 40% of the index or something? I mean, it's just crazy, crazy. We've all read the history books and we know that doesn't last. And the rotation, I think, away from the US, which will last time was 8 years, for Japan has just been 35 years. I think we're going to have a long sustained period of US underperformance and the rest of the world will shine. And the starting point is fantastic. 70% of the world index is American. And then, you just have to think about a seesaw with a large lad on one side who's 70% of the mass of the combination and 30% on the other. What happens to asset prices when they neutralize? And that's a hell of a journey. And I think the difference between 2000 and 2008 period, where it was all about EM in Europe, I think that Japan has a good chance of being at the front this time. And I'm sure Europe and EM will feature well too. But I have a sneaking suspicion that it's Japan's turn after all these years.
Well, the Japanese market has, I think, just hit an all-time high, hasn't it, for the first time for 30-something years, something like that, and been performing very well this year. So you like Japan as a destination?
I do. I think that it's got so much going for it at the moment. If you think about the currency, it's very cheap. So that's on your side as an investor. The bond market's normalizing. We're going to see some gentle rate hikes over the next few years. Land prices are rising. House prices are rising. All the problems that you can look back after the biggest bubble in history in 1990 and the pain it is to unwind a bubble of that size. I think you can put most of those negatives behind it. You've got good governance in Japan and companies are buying back shares and the earning growth outlook is very strong. They just got great companies. Now, it's true that Japan didn't create these mega tech businesses. Well, SoftBank, I suppose you might include, but neither did Europe. And that's the American exceptionalism. Silicon Valley, their ability to have a venture capital sector that will just chuck $1 billion in an idea and market it to death before it's made a profit. So, yeah, the Americans have had a great trick there, but I'm not sure if you can repeat that going forward. A lot of the land grab for the internet is done, isn't it? Presumably.
Yes, and there's going to be quite a lot of an arms race going on, certainly in the field of AI. It's going to absorb an awful lot of capital, and all of which can make money. What about China? Have you views on China? I mean, some of us take the view that we're not necessarily very keen on investing in China for all sorts of
Yeah.
reasons. But it's there, it's part of the world index, it's a significant part of the emerging market index. What are your thoughts about China?
Well, we hold the Hang Seng Tech ETF. I think that's not a very difficult decision to have a small position in that. The broader market, nothing's jumped off the page for me at this moment. I don't really understand Chinese companies, and I'd only ever recommend a Hong Kong stock rather than a Chinese stock for the simplicity of trading. But yeah, I suppose I'm bullish. I mean, the valuations are cheap and it's a big country. You don't have to be a democracy to make money. Singapore's proven that. It's something that we think is true in the West, but it's just not true. And so China could be very, very successful. And it does seem to be that recently we've had less of a punch up between America and China in recent months compared to a year ago when everyone was very worried about the Taiwan Straits and so forth. So I assume that China is going to be a good investment over the next 10 years, unlike the last 10. It has its demographic problems, but doesn't everyone? So, India is probably one of the countries that doesn't, some of the frontier markets. But basically, if you've got a large, innovative nation with lots of good businesses, then what's not to like? Of course, there are state-owned companies which you wouldn't want to own. And so I think the index funds are always going to be a little bit complex. And so that's why I was very keen to own the Hang Seng Tech, because it's straightforward private sector and the valuations were good after one hell of a bear market from 2021.
What about India? As you say, they have a lot of things going for them at the moment, though they seem to have a bit of a issue with Mr. Trump at the moment. We're going to come back to him in a second. But what do you think about India? Do you have a view there? Obviously, people say the market's very expensive, always has been, and probably will be for a while.
Yeah, I don't own India. I haven't owned it for quite a long time. I think that one of the reasons India's underperforming is because China's outperforming. So I think they're a natural pairing. You wouldn't really need to own both of them in quite the same way because you'd make a choice of whether it's India's turn. So one of the reasons why Indian stocks had such big flows was because in the EM index, it was a major constituent and people were taking money out of China. So that's now returning to China and presumably coming back out of India. So I think that's a very simple argument. But the currency is not very good. And generally, if the currency is not working, then you're not going to outperform with a falling currency. So I don't think that's probably a good thing. And also in our screens, we're seeing quite a lot of technical weakness in Indian stocks right now. But long term, India's a fabulous stock market, and I'm sure the country's got a lot going for it. But I don't have a position right now.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So now we're 7 months into the new Trump administration, and we obviously have the whole tariff business. We have his stated ambition to get the dollar down, which seems to be working. What's your verdict on what he's been doing, and how important actually is it to how markets are going to perform over the next few years? Do you think they've rumbled him?
I think it was really important a year ago when he was coming in, or was he coming in? And then he came in and he started shouting about tariffs and things, and there was a lot of confusion. But I think behind Trump is Scott Bessent, who's a pretty smart character. And he knows what he's doing. He's been running hedge funds for years for George Soros and that sort of thing. So they have got some brains in the room, whatever you might think of Trump. And I would suspect that the markets will get less and less anxious about Trump going forward, because whatever happens, the whole chicken thing. I mean, I think that some of the things that Trump's done are absolutely brilliant. And other things, he's not the sort of person I would want my daughter to marry, if you know what I mean. So I think that's my misgiving about him. But I have to say that he's been very effectual in other areas. But it is a strange old thing seeing all these leaders from Europe and so on just sort of hanging around him. It's bizarre.
He wants to run a court, basically, an old-style kind of French court. So this is the reign of Donald I, or whatever it might be.
In the press, they had Professor Trump showing all the foreign leaders around the White House and then took them to the gift shop at the end. That made me cry.
Yeah, one shouldn't laugh about these things in a way because it's quite important, but there are some humorous aspects to it for sure. Now, for many years, you managed in an institutional framework multi-asset global portfolios for HSBC. Now, effectively, you're doing something similar through your own research and publications and ventures. What role do investment trusts play in that historically, and why do you look at them at all if you've got the access to so many other instruments around the world?
Well, I like them because when I sort of think about if I was to die rich, which I'm still planning to achieve, then what would I do given my kids have no interest in finance? And you just sort of think to hand down a whole lot of investment trusts seems like so much better an idea than a whole load of unit trusts. Because there's a board, and if something goes wrong, the guy gets fired or the girl gets fired, and they can merge and remain relevant and this sort of thing. So I just sort of think that your stewardship in investment trusts is outstanding. And I've always admired that. But I have to say, we are outgrowing them. So I own fewer these days because we do move the price when we recommend them. So the number of investment trusts that we look at is shrinking. And I'm a little bit sad about that. But in our venture service, which is a sort of anything goes, we do look at some of the smaller ones and, just say it's a liquid, watch out. But in our core services, we don't. We make sure liquidity is high in everything we do.
So can you give me some names of things that you own, and if so, why you own them?
Of course, I can do that. Let's start with the basics. I've always been a great fan of capital gearing and Ruffer. And so those are core holdings for us. And, I'm saying they haven't done well compared to the portfolio over the last 10 years. But nevertheless, I like having them do the equivalent of what you might have called a bond book in the good old days. I haven't really had much time for the bond market in recent years. And so I just leave it to them. And I know they're not entirely bonds, but they're mainly bonds. And I think that having some conservative money in a portfolio is an important feature of portfolio management. It can't all be go-go. You've got to have some low risk, some medium risk, and some higher risk, and get the position sizing right and that sort of thing. So I have those at the core of the portfolio. Also in the sort of risk off section, if you want to call it that. I don't really like calling a macro hedge fund risk off, but let's say low correlation is probably a better description. We do own BH Macro. My favorite investment trust of them all is AVI Global Trust. I think they're a class act and they know how to pick stocks and they just keep recycling that value. And so I do see them as a core holding. What else have we got? On the discount side, Pantheon, private equity, Caledonia, a bit of private equity, Rick Capital, a bit of private equity, not very big positions. I'd love to increase them if I had confidence that the private equity thing was going to be resolved or realized, or call it what you will, but we're not there yet. So I am looking to increase those at some point. And I think the last one we own is a little bit of BlackRock mining. I enjoy that one too much to not own it. I've always appreciated the BlackRock mining team. And then on our high risk portfolio, we have got one. We've got Seraphim Space and Agile AVI Japan. That's it. Those are our investment trusts that we've currently reviewed.
There are some alternatives to investment trusts and traditional open-ended funds in the fund sphere, and that would include active ETFs, and it would also include these long-term asset funds that the government has been talking about introducing in the UK or promoting in the UK. So obviously designed to get pension funds to invest in things that the government would like them to do. Do you have any thoughts about those two types of instrument?
Well, let's start with active ETFs because they're interesting. And I think they're a natural follow on. I mean, the ETF industry, what is it, 14 trillion or something? That was probably last month. It's probably another trillion by now. It's a huge, huge industry and has reshaped markets in so many ways. So the success of the ETF is it's a better distribution mechanism than an open-ended fund. So if you're a Vanguard type tracker fund and you have a UCITS whatever with a currency class and you call your broker and it takes half an hour to find it and open an account and this sort of thing back in the day. And then these days you just get a ticker and buy it in 2 seconds. It's so obvious that the ETF is a superior distribution mechanism than the traditional fund. So yes, I'm a huge fan of the ETF, and the natural progression is active. I do believe that the active ETF industry does have a bias towards lower turnover funds. So it's something that's very well suited to Terry Smith or Linsell Train, those sorts of big funds which don't move the stocks around much. Ideal, and I don't know why more of these companies haven't done it. It's beyond me. It's clearly a superior way to distribute funds. Do you want to talk about that, or do we get straight to the government thing?
Long-term asset funds. So
Yeah.
which the idea behind this, I should explain perhaps to people, is that you encourage people to invest for the longer term, but as the price for that is you have reduced amounts of liquidity. You have some liquidity, but not much. In other words, you can redeem part of it some of the time, but not all the time. That seems to be a bit of a dog's dinner to me.
Yeah, I've lost interest in that description you just given me. The elevator pitch from Jonathan Davis, I've completely lost interest in this idea. I mean, I don't like illiquid assets for, trying to be dressed up as retail and liquid. It's always been stupid.
It's never worked well in the past, that's for sure.
Yeah.
Okay, so let's finish by talking about some other things that you own. You are a stock picker. What kind of things have you been looking at recently and why? You're a value investor, you keep telling us that, but with a bit of momentum thrown in, if I can try and put words into your mouth.
Yeah. I mean, I have to say that I've been through different styles over the years. And there was a time when I very much embraced momentum when I had a momentum strategy at HSBC. And I look back on it, and although there were times that it was successful and times that it wasn't, came to realize that when you have an audience rather than your own fund, it's really important to have a high degree of certainty you're not going to lose money. That's why I'm a value investor, because I'm in the publishing business. And I want things to go up and not down. And we have a diversified portfolio and we embrace momentum and value, I think you'd probably best call it. And we're just looking for solid companies, good balance sheets, low valuations, catalysts for change. So it's straightforward stuff, but it works. Do you want me to give you a few stocks that we've put in recently?
Yeah, sure. Just a few to give us a sample of the way you think about things, I suppose.
We got a couple of boring stocks, and then we got some more interesting ones. So Associated British Foods, which if you have a teenage daughter, she'll call it Primani or Primark on the high street near you. And obviously that's the Canadian family who have done very well in all sorts of things that they've touched. And then we have another boring stock would be Reckitt Benckiser or DCC. So I like to have a bit of quality in the portfolio. And WH Smith, something that I keep thinking that, you go to WH Smith and your eyes pop out when you see how much a Mars bar is or a biro in an airport or something. You think, crikey, they must be doing well. But it's been a sort of value stock that hasn't done very well for us yet, but I still have great hope for it. We managed to buy the low on Prudential this year, still running that, which is basically an Asian company these days. Smith's Group, we got that on the nose. Grifols in Spain, a blood business, that's done well for us. Spirax. And then we own lots of gold and silver and that kind of thing as well. So that's our sort of what we call the whiskey portfolio. We have a whiskey and soda portfolio, Jonathan. So the soda portfolio is basically collective investment schemes, either ETFs or investment trusts. And then the whiskey portfolio, think of it as a global equity portfolio with a heavy UK bias. But it wouldn't have to have a UK bias. It's just Most of the clients are British, not all. And it's a market we know well. It's a market that's doing quite well at the moment. So it could be much more international potentially. But when you come to exotic markets, then you tend to look at the ETF. So, for example, if I was to be bullish on Brazil or India or something, then the ETF would find its way into the portfolio.
So the UK market, it has been doing well. Who'd have thought it would get to 9,000? It was stuck at 7,000 for what seemed like forever. And it seems to be doing quite well, despite the fact that perhaps this government isn't as pro-business friendly as some of us would like. Do you have a view about the current Labour government, what it's doing and how well it's doing?
Of course I have a view. I'm not sure I want to share it. They just seem to break every rule. For their policies, you just know they're going to fail time and time again, and they keep going anyway. It's a strange one. Looking at the gilt yields, you can't tell me that the reason our long bond is where it is because that's indicating high growth in this country. It's just not the case. It's telling us something else. And this country needs a Millet desperately, an Argentinian type Millet, to balance the books. We balanced our books up until the end of John Major, and then in 2001, after the 3G auctions, Gordon Brown managed to balance them for 1 year. But we haven't balanced the books since 2001. I wrote a piece about a year ago on the difference between Switzerland and the United Kingdom, and you could tell the story through the budget. And as they balance their budget, they've had lower inflation and an appreciating currency. There are other reasons too, of course. But then we've got this structural deficit, and we're maxing out the credit card as a nation. And it's just not the right place to be. Governments should be frugal. They should have plenty of firepower for an emergency. And we're just not in that position at all anymore.
No, indeed. I think I have to agree with you on that. What I think is disappointing about the current administration so far, and this is not making a political point so much, it's just that they don't seem to have joined up thinking at all. They're doing some things in one area which totally conflicts with things they're doing in another area. It doesn't really inspire confidence that they've really got a coherent idea of what they're doing, which, whatever you think of the politics, is disappointing when governments don't act optimally.
Well, they don't have a plan. It's very clear they don't have a plan. I think that Labour in opposition were a very effective opposition because they turned the Tories into Labour, didn't they? Let's face it. But in government, I don't think they had a strong plan. They realised it's actually quite difficult to run a country. And I go back to Switzerland and say, I just wish we had politicians like they do there, where no one knows what they're called.
Yeah, no one knows who they are, and they're not courting the publicity all the time. You're absolutely right. Okay, so on that note, Charlie, that's very helpful. Thank you so much for sharing your ideas and thoughts today. I'm getting a feeling, though, that you're still fairly bullish about the outlook from here. There are lots of problems around the world, but they'll still find things to buy.
Find things to buy, Jonathan, but make no mistake, if it hasn't come across, the US stock market is a gargantuan generational mega bubble. So I hope that is clear. That is absolutely my view. And the investor over the next 10 years who can diversify away from that will do well. Of course, in the good old days, you just bought bonds, but that's not even clear that that's going to work nowadays. So every crisis we've been through in my career started in the late 90s. The first time in .com, all you had to do was not own .com. Corporate bonds worked, government bonds worked, real estate worked, small caps worked, anything, emerging markets, whatever. Next time, it was just government bonds and a bit of yen and dollar that worked. And then after 2020, it was pretty much nothing. And we really are running out of things that you can call a firm risk-off asset. And that does bring us back to gold, I suppose, and its young challenger, Bitcoin.
Very good. So that was Charlie Morris, the founder and CEO of ByteTree Asset Management. Thanks to him for coming on, and we look forward to having another episode next week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.